Yeah, I'm going to be doing just a short series of videos that will enhance what we've been talking about through the chapters 1 and 2. So this is a chapter 2 presentation of manufacturing costs and the flow of those costs from manufacturing overhead into work in process. So this problem is out of your textbook, workbook actually, and they give you a series of expected costs. These expected costs are the same as budgeted costs or anticipated costs that are going to come up in the future but have not yet actually happened. So what we want to do is first is to go down here and just identify each one as a period cost, or a manufacturing cost. And once you determine it's a manufacturing cost, I don't know if it's direct materials, direct labor, or if it's overhead. Remember, overhead is anything indirect, or you could say anything that's not direct materials or direct labor. So I've done a lot of the work, and the idea here is not for you to do the work, but to just watch me do this demonstration. So I kind of color coded it so you could see how this is going to flow and work. So first off, we need to know what our expected costs are. We always do. Business succeeds by planning, through planning processes, and then evaluating actual results to expected results. So what I did is I labeled everything yellow as a period cost. Take a look at it and see if it doesn't fit into the category period. These are going to be put on the income statement at the time in which they are incurred. So we're going to kind of ignore those completely. So what we want to do now is we want to find our direct materials. And it's labeled right there, but I want you to know something about direct materials. It's its own inventory account. So it has a debit side and a credit side. It is inventory, it's an asset, it has a normal debit balance. Direct materials often has a beginning balance, and you have some additional purchases, and then you have an ending balance. And the difference there is that the raw materials that leave that account usually go to either work in process if it's direct materials, and if it's indirect materials, it goes down into overhead, as you see, could be right here. This is the actual overhead that happens. All right, so direct labor is labeled in blue, and direct materials green, and then red is our indirect costs or overhead, which is really what this video is about. So I total up all those costs in that different area, and I double check to make sure I've got $7,934,000 in total expected costs. Sure enough, that balances. So now what we do is we move over into our manufacturing overhead. Now let's enter here on the debit side the actual overhead that's occurring during this period. So what we do then is we pull the actuals from here over into overhead. This is all done by journal entries. So as an example, the depreciation entry would be a debit to manufacturing overhead, a credit to accumulated depreciation. Factory supplies would be a debit to manufacturing overhead and a credit to probably accounts payable. All right, so either way, it gets into manufacturing overhead. And now we've got our total overhead that actually occurred. Now, how much of this should be assigned to any given job? Well, what we have to do is we have to calculate the predetermined overhead rate. Okay, and that's going to be the topic of the next video.